Affordability has reached its lowest point in recent history. Reminiscent of the historical cycles of rise and fall in the real estate market, people are struggling to both buy and rent homes. This year, we may witness another downturn, signaling the impending tough times ahead. The current state of the housing market is unprecedented since the 1980s, with rapidly rising interest rates and stagnant housing prices. As experts sound the alarm about the fragility of the housing market, it's time to face the harsh realities and prepare for what lies ahead. Please don't forget to subscribe and leave a like under the video. In 2024, the housing market continues to be shocking, with various factors contributing to instability. Rising interest rates and stagnant housing prices have led to a frozen market where buyers struggle to secure mortgages and sellers hesitate to make sales. Expected to reach the lowest levels of existing home sales since 1995, pending sales are at historic lows since records began in 2001. Despite an 18% population increase, homeowners are reluctant to move due to favorable mortgage rates obtained through refinancing. This situation resembles the early 1980s when mortgage rates skyrocketed. However, despite temporary setbacks, housing prices continue to rise overall. Today's challenges reflect those of the 1980s, with rising mortgage rates, high prices, limited supply, and strong suppressed demand creating economic tension. Home builders struggle to meet demand, resulting in a significant housing shortage nationwide. Looking at 2024, the situation worsens with pandemic-induced demand driving prices even higher. Mortgage rates have soared to historic highs, making home ownership increasingly unattainable. While analysts predict a potential decline in the housing market, affordability remains a significant concern. The ratio of average sale price to income serves as a fundamental measure of market valuation, indicating whether the market is overvalued or undervalued. In 2024, the housing market faces unprecedented challenges for both buyers and sellers due to affordability, rising mortgage rates, and limited supply. According to CNN, we are grappling with the worst economic crisis since 1984 nationwide. It now requires an astonishing 38.6% of the average household income to cover the average monthly home purchase. Typically, a home is considered affordable if this figure falls below 30%. However, this threshold has been exceeded in 99% of the USA. Realtor.com emphasizes the need for an annual income of approximately $110,000 to qualify for the average home purchase, with a 20% down payment for the average American earning $71,000 annually. This figure rises to $161,000 on the West Coast. Matthew Graham, Chief Operating Officer of Mortgage News Daily, aptly describes this reality as painful and ugly, echoing the sentiments of many striving to overcome the turmoil in the housing market. During the first 2 years of the pandemic, the Federal Reserve took harsh measures by lowering the benchmark interest rate to zero and injecting funds into mortgage-backed securities. This fueled a buying frenzy, coupled with the rise of urban migration and remote work, leading to historically low mortgage rates. As a result, home prices surged by a staggering 40% compared to pre-pandemic levels. Despite expectations, the increase in interest rates did not lower housing prices as in previous market trends. The current scenario is marked by a significant housing shortage, exacerbated by both rising rates and the 2008 Great Recession, which severely impacted home builders. October 2023 data reveals a consecutive 4.8% increase in home prices for the 9th month in a row, and existing homes being sold at near record levels. The National Association of Realtors reported a 4% increase in average home prices compared to the previous year, marking the 5th consecutive month of increase. However, this increased demand is met with an infuriatingly tight market, with the National Association of Realtors reporting a 3.5-month housing supply in November. Rick Arello, president of New American Funding, emphasizes that this shortage will prevent any decrease in home prices, underscoring the challenging landscape potential home buyers face. Realtor.com's December 2023 Housing Market Trends Report highlights the impact of high mortgage rates, resulting in a 6.1% increase in the monthly cost of financing a typical home compared to the previous year. After a 20% down payment, this means buyers today face an additional $123 in monthly costs compared to last December. Housing experts are anticipating a correction in the market, although they aren't foreseeing significant price drops akin to those seen during the Great Recession. Surprisingly, what's driving consumers to perceive it as a bad time to buy homes is that high mortgage rates are now overshadowing high home prices, leading to the lowest reported consumer confidence yet. These factors lay the groundwork for potential external influences that could negatively impact the real estate market in 2024. However, it's only a superficial understanding of why housing prices might start rising again and what measures could be taken. The most crucial factor to consider is the drop in interest rates. Wells Fargo predicts that home prices will continue to appreciate by 2.5% in 2024 and 4.4% in 2025. Similarly, Zillow forecasts a 6.5% increase in home prices by July 2024, and Goldman Sachs agrees, stating that the likelihood of home prices falling is low at current levels. Who bears the burden of the current housing market scenario? Potential sellers find themselves in a tight spot. They hesitate to relinquish the current 3% mortgage rates for fear of the possibility of an 8% rate in a new purchase. Why switch from a $2,000 monthly payment on a 3% mortgage today to a $3,300 payment on the same mortgage at today's 7% rate? However, research conducted on the belief that interest rates will drop indicates that a decrease in the 30-year fixed-rate mortgage to 5.5% could be a turning point that encourages more home buyers to enter the market. Moreover, homeowners who are also potential home buyers may see the price decline as an opportunity to quickly sell before the competition intensifies, potentially leading to a sudden increase in inventory. Graham from M&D states, "I don't think anyone in my mortgage creator community will argue against the idea that in many ways it's worse than the great financial crisis in terms of volume and activity." In the midst of this uncertainty, experts are trying to predict when the market might experience a decline in interest rates. A financial expert hears a group of fence speakers saying they are constraining themselves and waiting to see how policies will reflect on the economy. The implications of these decisions on daily life raise interesting questions. Consider this alarming fact. According to the National Association of Realtors, sales of previously owned homes in September 2022 saw their slowest pace since October 2010. However, our current housing environment is significantly different from the foreclosure crisis era. Foreclosures are at historically low levels, and homeowners today are benefiting from high equity due to record low interest rates between 2020 and 2022. Surprisingly, potential buyers find themselves in a tough spot. Real estate agent Lisa Rich says, "I think people are concerned, and buyers have a wait-and-see mentality. So many people are sitting down to see what will happen." In Washington, D.C. with Compass, considering these uncertainties, how do you think this waiting game is affecting both buyers and sellers? K.H. Johnson, a housing economist at Florida Atlantic University, paints a picture of the housing market being pulled in different directions. He suggests that we may enter a period where home prices remain relatively flat nationwide. While high mortgage rates exert downward pressure on prices, strong demand from new households and a shortage of homes for sale also push prices up. For now, these opposing forces seem to be balancing each other out. While construction of single-family homes is gradually increasing, it still can't meet demand. Builder confidence is declining due to high rates, but the new home market continues to be more active than the existing home market. As a positive development for housing, the record number of new apartments entering the market is finally slowing down apartment rents. With cooling rents, tenants may feel less pressure to buy. However, chief economist Jay Parsons notes that there is an increased demand for rental among young adults, particularly with slowing inflation and a robust job market. However, for those looking to move into larger or smaller homes, the situation is becoming more challenging. Prices continue to rise due to supply and demand imbalances, but sellers are becoming more flexible. A buyer may choose to buy at higher prices now, hoping to get a better price later, or wait for rates to drop. However, the problem is that when rates do drop, there could be a flood of people wanting to buy, leading to bidding wars. Let us know what you think in the comments. Thank you for watching Wealth Stream 101. Don't forget to subscribe to the channel and leave us a like below this video.